Hey everyone, welcome back to Finance Explained, the channel where we make finance fun and accessible for everyone. Today we're going to be doing a deep dive into one of the most popular ways to invest your money, the stock market. We know that the stock market can be intimidating, but don't worry, we've got you covered. By the end of this video, you'll understand the basics of investing in the stock market and how to choose which stocks to invest in and strategies to minimize risk and maximize returns. So let's start with the basics. What is the stock market? In simple terms, the stock market is a collection of exchanges where stocks or shares of ownership in companies are bought and sold. When you invest in a stock, you're essentially buying a small piece of ownership in the company. And if the company does well and makes a profit, the value of your shares can increase, which means you can sell them for more than you paid. But of course, there's also risk involved. If the company performs poorly or the market takes a downturn, the value of your shares can decrease, which means you could lose money if you sell. So, how do you choose which stocks to invest in? There are a lot of different methods and strategies, but here are some key things to consider. Number 1. Do your research. It's important to thoroughly research any company you're considering investing in. Look at their financial statements, earnings reports, and industry trends to get a sense of how the company is performing and where it might be headed. Number 2. Look at the company's management. Strong leadership can be a good indicator of a company's potential for success. Look at the company's executives, their track record, and their reputation in the industry. Number 3. Consider the company's competitors. Is the company you're considering investing in competing in a crowded market? Are there other companies with better products or stronger brand recognition? Make sure you consider the broader industry landscape before making any investment decisions. Number 4. Keep an eye on the company's valuation. The stock price of a company can be influenced by a number of factors, but ultimately, you want to make sure you're not overpaying for shares. Look at the company's price-to-earnings ratio, P/E ratio, and compare it with other companies in the same industry to get a sense of how the stock is valued. Once you've done your research and chosen which stocks to invest in, it's important to have a plan for managing your investments. Here are some key strategies to keep in mind. Number 1. Diversify your portfolio. This is one of the most important things you can do to minimize risk. Diversification simply means spreading your investment out across different companies, industries, and asset classes so you're not relying too heavily on any one thing. Number 2. Rebalance regularly. As the value of your investments fluctuates, you may find that your portfolio becomes unbalanced over time. For example, one company's stock may perform well, while another's does not. Rebalancing your portfolio involves selling some of the stocks that have done well and buying more of the ones that haven't, in order to maintain a balanced portfolio. Number 3. Have a long-term mindset. Investing in the stock market is not a get-rich-quick scheme. It's important to have a long-term mindset and be patient with your investments. Over time, the stock market tends to go up, but there will be bumps along the way. Number 4. Keep your emotions in check. The stock market can be volatile, and it's important not to let your emotions guide your investment decisions. Avoid making impulsive decisions based on fear or greed. Stick to your investment plan and strategy, and don't let short-term fluctuations in the market deter you from your long-term goals. Number 5. Monitor your investments. It's important to regularly review your investments and make adjustments as needed. Keep an eye on the companies you've invested in, as well as any market trends that may affect your portfolio. Stay informed and make informed decisions based on data and research. Number 6. Consider seeking professional advice. If you're new to investing or have a large portfolio, it may be worth considering seeking advice from a financial advisor. They can provide guidance on your investment strategy and help you navigate the complexities of the stock market. Number 7. Stay disciplined. Investing in the stock market requires discipline and commitment. Stick to your investment plan, remain patient, and don't let short-term fluctuations in the market derail your long-term goals. With discipline and consistency, you can build a strong portfolio and achieve your financial objectives. Number 8. Understand the risks involved. While investing in the stock market can yield significant returns, it also comes with risks. It's important to understand and accept the risks involved, including the possibility of losing money. Don't invest more than you can afford to lose, and make sure to do your research and understand the potential risks before making any investment decisions. Now, let's talk about some common misconceptions about the stock market. Number 1. The stock market is not the same as the economy. One common misconception is that the stock market reflects the overall health of the economy. While the stock market is influenced by economic conditions, it's not a perfect indicator of the economy's performance. Number 2, the stock market is not a get-rich-quick scheme. Another misconception is that investing in the stock market can make you rich quickly. In reality, investing is a long-term game, and it requires patience and discipline. Number 3, the stock market is not only for the wealthy. Contrary to popular belief, you don't need to be wealthy to invest in the stock market. Anyone can start investing with a small amount of money and build a portfolio over time. Number 4, the stock market is not predictable. Many people believe the stock market is predictable and can be timed perfectly. However, the reality is that the market is unpredictable and subject to fluctuations caused by various factors. Number 5, the stock market is not immune to fraud. Despite regulations and oversight, the stock market is not immune to fraud. Investors must do their due diligence before investing and be wary of schemes that promise high returns with little risk. Number 6, the stock market is not just for short-term gains. While some investors may focus on short-term gains, successful investing in the stock market requires long-term perspective. Investing for the long term can help you weather the market volatility and maximize your returns. Number 7, the stock market is not a substitute for a financial plan. Finally, it's important to remember that investing in the stock market is just one aspect of a comprehensive financial plan. Investors should also focus on other areas such as budgeting, savings, and retirement planning to ensure long-term financial stability. One of the biggest myths is that you need a lot of money to start investing. In reality, you can start investing with as little as a few dollars through apps like Robinhood or Stash. Another misconception is that investing in the stock market is like gambling. While there is certainly risk involved, investing in the stock market is not the same as gambling. Finally, let's talk about some fun and interesting facts about the stock market. Number 1, the earliest recorded instance of a stock market dates back to ancient Rome, where traders would gather in a marketplace known as the Forum Romanum to buy and sell shares in government-owned businesses. Number 2, during the Middle Ages, merchants in Venice began trading shares of individual businesses, and by the 16th century, the Venetian stock market had become one of the largest in Europe. Number 3, the bull market of the 1990s saw the rise of tech companies like Microsoft and Amazon, and the dot-com bubble of the late 90s and early 2000s saw many internet startups fail and investors lose billions of dollars. Did you know that the New York Stock Exchange has roots dating back to 1792 when a group of stockbrokers signed the Buttonwood Agreement? Or that the stock market has historically gone up over time despite occasional downturns? And did you know that some companies, like Amazon and Google, have never split their stock, meaning that their share price is in the thousands of dollars? This is because stock splits can actually hurt a company's valuation in the long run. So, there you have it, a beginner's guide to investing in the stock market. We hope you found this video helpful and that you feel more confident about investing your money. Remember, the stock market can be a powerful tool for building wealth, but it's important to do your research, have a plan, and be patient. Thanks for watching Finance Explained, and we'll see you in the next video.